So in this video, we are going to discuss about adjustments. So adjustments are after the preparation of trial balance and before the preparation of SOPL and SOFP, there might be some kind of transactions that the company might have. So these outstanding transactions or transactions which have occurred, they have to be entered into the SOPL and SOFP. Okay. So what happens here is now only the journal entries are passed. Okay. So these entries have to be like added with the trial balance and they also move to the SOPL and SOFP. So you would have already seen the movement of entries or numbers from trial balance to SOPL and SOFP. So if you have looked at it, you would have observed that any item appearing in the trial balance, you can see this note, any item appearing in the trial balance will be posted in SOPL or SOFP only once. Okay, but if any item appears in the adjustments, it appears both in SOPL and SOFP. Okay, so it occurs like once in SOPL and once in SOFP. Okay, so as it appears in both, the balance sheet will again tally. Okay, so our concept is here to explain you all the adjustments that are there. Okay, there are around some 10 adjustments we have picked up. Okay, and these adjustments is what we are trying to show you. So there are some difficulties in teaching this concept here. Okay, because like the statement which we are using here is IFRS statements. Okay, but actually to show this, it is quite easy to show these adjustments in a Indian version of accounts. Okay, but even Indian version of accounts have now adopted this kind of formats only. Okay, so it's quite difficult now actually to teach these concepts in through these two statements. Okay, earlier there was like another kind of statement, okay, ledger kind of a statement, which was like so easy to teach, but now we have these statements, so it's a little bit difficult to adjust. But if you could focus nicely, then you can understand the concept. Okay, so first we'll start. See, the first one is closing stock. Closing stock appears in two places. So once it appears as a item in the cost of sales, okay, and again it appears in the balance sheet asset side. Okay, so we'll first see on the SOPL. Okay, see in SOPL what we'll do is we'll show it as 10,000, okay, as a closing stock. But what happens in SOPL is you have all these numbers. Okay, all these numbers, we'll put it as 0. Okay, then you deduct the cost of sales. So it's like all these numbers deduct by cost closing stock. So if you deduct it by closing stock, you'll get minus 10,000. Okay, in accounts we can't have any number called as minus 10,000. Okay, it's only like all positive numbers we have. But how can we show this minus 10,000 is, see, this minus 10,000, okay, if I put it here, okay, if I put it here in cost of sales, you can see that this cost of sales is a deducted number. Okay, right, it's a cost of sales is a deducted number, so it would actually become a positive number at the net profit region. Okay, it will become a profitable number in net profit region. Okay, so you could see here these numbers are pulled, and finally equity side it is showing 10,000. But what about the asset side? On the asset side, you have item called as inventory. There you can post 10,000. So now you will get both sides equaling to 10,000. Okay, so that's about the concept here. Hope you got the idea here. So your job is very simple. Post once in cost of sales, okay, in closing stock, and post once in uh, asset side. Okay, so that's about the concept here. So to teach you better, okay, what we'll do is we'll make two more assumptions. Okay, we'll make an assumption that there's a cash sales. Okay, there's just a cash sales that the company has already have done. Okay, and that comes to like 1 lakh. So if you have a cash sales, your revenue would be 1 lakh, right? And your cash should be 1 lakh. Okay, we'll just have these two so that we can show you a better picture of how things occur. Okay, So we'll go to the next adjustment. Okay, so we'll go to the next adjustment. So the next adjustment is outstanding expenses. So outstanding expenses, it tells you for the year 2017, rent is payable at 2000 per month, and during the year 20,000 is paid on account of rent. Okay, so uh, rent is usually shown in administrative expense, so we'll put it there. Rent paid. So rent paid by the company is 20,000, and every month they have to pay 2,000. Okay, so 12 into 2,000 comes to 24,000, but they have only paid 20,000. So balance the 4,000, okay, is rent outstanding. Is rent outstanding. Okay, see, the rent amount would have already occurred. Okay, would have already occurred in the trial balance. So it has to be shown only once, but outstanding has to be shown twice. So where it would come. So we'll take these numbers and we'll use them. So if you see here, administrative expense, okay, both put together, rent outstanding and rent, okay, comes to 24,000. Okay, so it comes to 24. The rent outstanding, okay, is a liability. The rent outstanding is a liability. So you can put outstanding expenses on the current liability side. So you can put it under this heading. We'll put it here. So rent outstanding would be 2,000. Okay, sorry, it was 4,000. Okay, but why is it not like tallying? Okay, why it is not like tallying here? See, it is actually tallying here. Okay, what happens is we have taken the 20,000, which should be shown like only once, right? Okay, we should have shown it only once. That's why it is not like, it's not like tallying. Okay, so if you show it as 4,000, only the outstanding amount if you show. Okay, I'll just show you the outstanding amount. This is the outstanding amount. If I show this, you could see the balance sheet still tallies at 00. Okay, so which is correct? See, you should show the trial balance number as well as the outstanding adjustment number. Both you should show. Okay, so this is just for your understanding purpose. Okay, the rent outstanding 4,000 we have entered here, which is a loss for the company. Okay, and this has not been still paid. Okay, so it's a liability for the company. Okay, so both gets adjusted and becomes 0. But how much should we show? We should show only 24,000. Okay, we should show 24,000 here. So that is like the 20 plus 4,000, and finally it comes like this. Okay, so ensure that you understand how the numbers keep moving. Okay, so now we will see again about other numbers. Hope you understood outstanding expense. We'll go to prepaid expense. Okay, see, prepaid expenses for the next year expense you have paying now itself. Okay, you are paying now itself. So it's not required for you to pay it now, but you have like voluntarily paid. Okay, so this is not this year's expense, it's only like next year's expense. Okay, so how should we account it? See, insurance premium of 6,000 for a year is paid on 1st January. Okay, it's paid on 1st January itself you are paying. Okay, and the accounting year closes on 31st March. So how would we account this? So first we'll copy the sentence. again it will put it in administrative expense. Okay, so first we'll say insurance. See, insurance they have totally paid 6,000. Okay, but this 6,000, okay, but this 6,000 is for how many months? It's for 12 months. Okay, it's for 12 months, it's 6,000. Okay, this year itself ends in 3 months. From January to March, it's 3 months. Okay, Jan, February, March. Okay, so balance 9 months, it is prepaid. Okay, so what if there's anything prepaid, you have to less it. Okay, less prepaid. Okay, so now we got the idea here. So what would happen here? See, in your P&L, you show 6,000, okay, and you deduct 4,500, and the current year insurance, okay, current year insurance alone you have to show. Okay, you should not show things which are more than that. Okay, you should show only that number. Okay, but okay, but as you have paid this year, okay, your cash has gone out. Okay, your cash has gone out. So the total insurance paid you should show as 6,000. So we'll show it. We'll just show it. You can get an idea. Okay, the total expense is 6,000 which you have paid. Okay, out of this, there is a prepayment. Okay, prepayment, here you have that prepayment insurance. So prepayment insurance or prepaid insurance is 4,500. Okay, so the insurance totally paid is 6,000, the prepaid is 4,500. So we have to show 1,500 as the current year administrative expense or insurance paid. So if you see here, it goes to 1,500. Okay, so why it is not getting tallied? Okay, so why it is not getting tallied? See, it's not required that it has to tally here. Okay, if you understand how the numbers work, that would be like more than fine. Because the reason why it might not like tally for us here is because there are like the current year expense and the prepaid expense. Okay, so that is the reason why it's not getting tallied here. So this is about the prepaid expenses. So once we do a lengthy problem, you will get an idea. As of now, it would be great if you can just understand the concepts. So we'll now move on to the third item. Okay, the third item is called as accrued income. That is, income has occurred, okay, but you have not received that income. Okay, so here they say that a business has a fixed deposit of 1 lakh with a bank for 12 months in the accounting period ending 31st March 2018 at 9% per annum. Interest received during the year was 6,750. Okay, so the 6,750 is the total income of the investment. Additionally they have to get the balance also. Okay, so what would be the amount? So first we'll take this and as it's an accrued income, okay, we can put it in the income, investment income here. Here itself we can try to adjust it. Okay, so first we will put like this. So interest, okay, for the year, how much it would be? It would be 1 lakh, okay, into 9%. Okay, that is 9,000 they have to receive. So that is their total income that they have to receive, but already received is already received. Okay, or we'll put like this: interest received is 6,750. Okay, the balance is outstanding or accrued income. Okay, outstanding or accrued income. Accrued interest is going to be the difference between the both. They should have received 9,000, but they have received only 6,750. So 2,250 they have to receive. Okay, see, this 2,250 is a income. Okay, it's a income and it has not been received, so it will be like considered as a asset. So you could put accrued interest, this number here, as an asset. So the value would be 2250. Okay, see, this 2250 have to be received for this income year itself. So the number would be 2250. Okay, so you could see here it is getting tallied. Okay, but is this the right approach? No. See, the total income earned for the year is 9,000. So this 9,000 has to be put here. Okay, we can't put only 2,250. We have to put the total income that is earned during this year. Okay, see, in SOPL, whatever amount is earned or paid during the year has to be shown. Okay, so necessarily your balance sheet will now not tally. Okay, it will not tally, because if I show you only the adjustment, it tallies. Okay, but if I show you that full transaction that has to be shown in the accounts, it will not tally. Okay, so only when we do a full sum, you will get an idea about what we are doing here. Okay, as of now, it's your job just to simply watch how the numbers are moving. Okay, so this is about the interest accrued. So the next is income received in advance. Okay, so they have receiving some kind of an income beforehand itself. So we'll put that here. So commission for the year. Okay, so this is what they have to show in the P&L. Okay, any commission that is only for this year, they have to show. So what is the total commission? See, it shows that the total commission received, okay, total commission received the total commission received has been 7,500. Okay, has been 7,500, and they say that adjustment, 1/3 of the commission received is in respect of work to be done in the next year. Okay, so 2/3 of the commission is actually for this year, right? So 2/3 of the commission, 2 divided by 3 into 7,500 is for this year. And the balance, okay, commission received in advance, so that would be would be 2,500. Okay, so the total commission received by the company has been like 7,500. Okay, out of that, this year commission is 5,000 and the next year commission received in advance is 2,500. First, See, this is the adjustment here, right? This is the adjustment here. So this alone first will show. So commission received in advance, okay, should not be shown in the P&L. Okay, so it should be shown only in commission received in advance, okay, is a liability. So that they have to show in the current liabilities part. So they can show it here. So it comes to 2,500. Okay, so of course necessarily this will not tally. Okay, and the total commission received was 7,500, but only the commission that we have earned for this year, that alone we have to show it here. So that would be 5,000. Okay, so that's about the idea here. Okay, so certain adjustments will not tally, don't worry about that, we'll see it in the lengthier problem. Okay, so you got the idea here. So here you should put only the commission that is going to be received in the year. Okay, here you have to put the commission which is received in advance as a liability, or income received in advance as a liability. So you show the 2,500 here. So that's about the income received in advance. So the next one is interest on loan. So you could see here the trial balance on 31st December 2016 shows 12% loan of 5 lakhs and interest paid on loan 45,000, and the adjustment is interest on loan is unpaid for 3 months. Okay, so again it's an outstanding expense. It's an outstanding expense. So treat that in that same way. Okay, so first we'll try to find out what's the interest amount. Okay, interest for the year, first that we'll calculate. So interest for the year would be 12% into 1 lakh, sorry, into 5 lakh. Okay, out of this, interest paid is 45,000 and outstanding interest is the balance 15. Okay, so in this year they should have paid 60, they have paid only 45. Okay, and the balance 15 is outstanding interest. See, this balance outstanding interest is a liability which you should show in the current liability. So here it goes to this part. Okay, it goes to here as 15,000. Okay, and the total interest for the year, okay, that should go to the interest part. So we can show it in the finance cost, 60,000. So that's how it happens. Okay, so you show the total expense for the year in the SOPL and you show the balance outstanding amount in the outstanding expense account. Okay, so that's about the interest on loan. So we still have like 4 more adjustments. So here if you see, we have interest on investments. Okay, so this is a interest accrued, I think, but not received. I think that kind of a concept should be. Let's see how it works. So trial balance on 31st December 2016 shows 12% investment of 1 lakh and interest received is 9,000. Provide for accrued interest on investment 3,000. Okay, so interest, so we will put like this: interest income, okay, for the year. So the total amount should be 1 lakh into 12% will be 12,000. Okay, received is 9,000 Okay, so the balance is 3000. So this is accrued, okay, interest. So interest income. Okay, so they are eligible to receive 12,000 this year. They have received 9,000. They have not received the balance 3,000. In this year, how much they have to receive? 12,000. So the 12,000 would be the this year's income. Okay, this would be this year's income. And how much of it has not been received till now? Okay, that accrued income, okay, will go to the SOFP. Okay, so accrued income 3,000 will be here. Okay, so I think interest on investment is also similar to accrued income only. Okay, there's nothing new here. So hope you have got the idea. So again, the concept is any income that is received in this year should be showed in this year. Okay, whether it's received or not, it has to be shown. And anything which has been not received, okay, we are eligible but not receiving, that we have to show it on the asset side. So now we'll move on to the next item, which is called depreciation. So depreciation is trial balance on 31st March 2016 shows a building as 50,000 and depreciate building at 10%. So we have a building which is 50,000 worth and depreciation is 10% of it. So 5,000. Okay. So first we'll put the machine. Okay. Sorry, the building worth is 50,000. So that we have to put. So we'll put it in the inner column 50,000 minus the depreciation is 5,000. So after adjusting, our machine would be 45,000. Okay, so one adjustment has come here. The other one, depreciation is an expense, so we can show the expense as administration or sales and distribution cost. Okay, any kind of cost or factory cost or something you can show. Okay, so 15,000 would come in this part. Okay, so if you see here, the minus 5,000 are tallying. Here you have 1 minus 5,000. If you do not take the asset value at all, here you would actually have just a minus 5,000. Okay, so either way it will get tallied. Okay, so in a lengthier problem it usually gets quickly tallied, but in this types of problem it takes a little bit time to understand. That's a problem. Okay, so hope you got the idea here. One adjustment has already been done on the asset side. So minus 5,000 has already been done. Here it is a cost. So this cost of minus 5,000 is entered in the SOPL. Okay, and that SOPL number flows to the retained earnings number, and that also comes to minus 5,000. Okay, so that's about the depreciation. So we'll move on to bad debts. Okay, so what is bad debts? See, bad debts is like you have sold some goods on credit and the customer has not paid you at all. Okay, and you are like 100% confirmed that he will never pay you. Okay, so what happens here? This is like very similar to depreciation. Okay, so the receivables would be total value they have given is 1,02,000. 1,02,000. Okay, done. Next one is bad debits written off is 2,000. Okay, so bad debits written off is 2,000. As you write off the bad debt, okay, it would be 2,000 here. It's a cost, so you book it as a cost, so it's 2,000 here. Okay, and the balance 2,000 should come in SOFP, right? One came in SOPL, the other should come in SOFP. So if you take it here, the balance amount would be 1 lakh. So if you could see here, one number we have taken in SOFP, so minus 2,000 we have done. Okay, we have reduced the asset value. As assets value has been reduced, equity value has also to reduced by 2,000, so it has also reduced. Okay, so we have reduced asset value, the equity value also has to get reduced. Okay, so finally we got the numbers here. So to reduce it, we actually post it to the P&L account. Hope you got this. and the last one is provision for bad and doubtful debts. Okay, so here you try to create a provision and you try to find out sorry, here you try to you know that you have sold goods on credit, okay, and you feel that uh, the creditors, sorry, your debtors might not pay you on time, okay, your bills receivable cannot be collected. So what you do is you create a provision that they might not be connected, okay. So again it works very similar to a bad debts, okay. So again here you have the receivable part, go there, you can just fully type the receivables amount. So that comes to 1,50,000 minus 5% of it is bad debts, okay. So how much is 5%? So that we have to work out. So that comes to 7,500, okay. So 7,500 you have to deduct from your asset. So from your asset side 7,500 got deducted. But what about the equity side? Okay, see, for equity and liability side also 7,500 has to get reduced, okay. So this 7,500, okay, we were booking it as a provision. So provisions should be like considered as a kind of loss, okay. So we can book it as 7,500, okay. It's not a loss, it's like providing for a loss, so that is also similar to a loss. So if you see, on asset side we've reduced by 7,500 the asset value, on the liability side we are reducing the numbers by 7,500, okay. So these are the provisions here, okay. We got an idea about all the provisions. Now our job is to apply these concepts to the problem.